Well, it was interesting that the last question there came from Jerome, and Jerome will get a chance to talk about his own views of the markets and assets just shortly, and at the panel session afterwards. We'll move on to our next panel conversation, ladies and gentlemen, and then we'll have afternoon tea, so you can get another hit of caffeine into you and get moving. What I'll do now is, please, we could have a bit of shush, folks. We'll move on to our next panel session. Our moderator for today's session, which is based around retirement incomes, a fairly vital topic, given it would seem from a themes perspective, you either want to take risk or there's no other option going forward from some of the themes I've heard. I imagine how your retirement clients are feeling just about now, particularly if they haven't got the prospect of any more dollars to supplement their portfolio going forward. That's all they've got. I'll get Matt Olson to moderate this panel. Matt's the head of research and retirement income at IOOF, but he's essentially a portfolio manager. Previous life, he was the chief investment officer of a $5 billion industry super fund, and prior to that, immediately after that, he was the chief executive officer at Lonsec. So he's got a broad and far-ranging background and experience. To discuss this topic, I'll ask Matt to please come forward and you can introduce the panel. Thank you very much.
Thanks very much, and thanks Toby for the invitation today. Great to be here. So I've got a very interesting panel session today. We've got three panellists. I'll ask them to come up to the stage first. Firstly, Victor Huang of Milliman. Victor's a principal with Milliman. He's their head of investment solutions, been there since 2008. He leads a team of portfolio managers, actuaries and traders who design and implement strategies. He has skills in tail risk hedging, currency hedging and dynamic hedging. Next to him is Andrew Lowe, who is the head of technical services at Challenger. Good to see you, Lowe. Responsible for the development of technical tools for advisors, an expert on pre and post-retirement, superannuation, and a range of other things like aged care and a range of strategies for advisors. So great to hear from you today, Loie. And someone who was probably well known to you, certainly well known to me, Lucas Deporbe, Head of Investment Solutions at Lonsec. Lucas has had a deep experience in retirement income portfolio construction, working with clients to construct portfolios. He sits on the Asset Allocation Committee at Lonsec. For asset allocation, also manager selection and stock selection. So I guess without further ado, in terms of retirement income, I think to set the scene, obviously a very difficult challenge in such a low interest rate environment. I think from our perspective at IOOF, we see the key risks that we have to deal with in a retirement income framework, obviously sequencing risk, inflation risk and interest rate risk. All of these factors are impacting whether or not retirees are going to have sufficient income, and obviously longevity risk. So I think the panellists today with their solutions deal with all of those issues, and I guess what we'll do is we'll get each of the speakers to speak today, and then we'll have some Q&A at the end. So if you've got some questions, Jerome, we can ask them then. So firstly, I'll introduce Victor from Milliman.
Hey guys. Hey, how's it going? This is kind of weird because it's the first live conference I've been to since January last year. I'm sort of waiting to ask everyone whether you guys can hear me or not, but you clearly can because I'm right here. Look, thanks Matt for the lovely introduction. Thanks Toby. Oh yeah, sure. Yeah, thanks Toby for inviting us all here. It's for me personally, I'm really happy to be here. Like I've been on paternity leave for the past 3 weeks of my first newborn, so I've been coming to appreciate some of the small things in life that you take for granted. So like today, I'm wearing a clean shirt, and it's making me feel really good. So yeah. Look, to set the scene about what Milliman's doing here, we're an actuarial consulting firm. We usually work with life insurance companies. We manage risk for life insurance companies. So you kind of wonder what it is we're doing constructing portfolios for retirees. But interestingly, the two things are actually quite well linked together. Both insurers and retirees do have that long-term cash flow requirement that needs to be funded with a really high level of certainty. And neither really have the appetite to invest in things like the magical Bitcoins or your Elon Musks and all that stuff. So we have to fund it with a portfolio of traditional assets. So with that, I want to cover three quick things today. First of all, I want to give a bit of an illustration of what some of the common investment-ish challenges would be for advisors when constructing a portfolio for retirees. And then secondly, I want to go through effectively in this low rate environment, like how much can you safely withdraw from your retirement pot for your clients? And then finally, I want to go through some of the solutions and approaches that Milliman is taking in the managed account space to address some of this. Disclaimers. There you go. Look, the retirement challenge. I've seen this presented and explained in many different ways. Just a caveat, I'm more of a numbers guy, so you're going to get some numbers from me. I'm sorry, I just don't know how to explain things without numbers. The crux of it is really quite simple. It really comes down to two things. Retirees need exposure to growth assets, and they need to be able to manage that increased exposure to sequencing risk. So on that first point, the need for growth assets, it all comes down to the fact that we're all living longer than ever before, so your clients' portfolios need to last longer than ever before. Now, and in addition to that, retirees tend to not want to reduce their quality of life when they enter retirement. And at the same time, the incomes that they want to take from their retirement pot, they want to see that grow with inflation throughout the rest of their life. Now, if you run the numbers on that, what you'll find is that the more you invest in growth assets, the longer your pot, the longer that nest egg is expected to last on average. And the key thing is on average. Now, if you look at a very simple example here, you have a retiree with around 200 grand in balance in their retirement pot, withdrawing maybe 12 grand a year. In a typical growth fund, that portfolio is going to last you around 26 years. But now, if that retiree went into defensive assets completely, now that portfolio is only going to last them 18 years. So it's a fairly substantial reduction in the longevity of their portfolio. Now, the next point, the problem with looking at averages, as I mentioned, is that you're not looking at risk, right? So if you look at averages, yeah, by all means, get all into growth assets. But now you've got to consider risk. That's where it comes to my second point around retirees having an increased exposure to growth assets, increased exposure to sequencing risk. So the chart on the left here, that's pretty colorful now that I look at it. What it actually shows is the number of income, the number of years of income that you lose from a 30% market shock occurring at various points in your life. If you zoom in on what happens to a 65-year-old, you can see that a 30% shock on that 65-year-old's assets will actually take around 13 years of income away for them. Now, if you do that same shock to someone a lot younger, like myself, like a 30-year-old, for example, you only take around 5 years of income away. Now, the reasoning for that is actually really quite simple. For a 30-year-old, if you lost 30% of your income, you still have 30 or 40 years to contribute back into that nest egg. And actually, the depressed asset values will help you purchase back into your portfolio at lower asset prices. So it's not all bad for you. But if you're a 65-year-old and you've had that 30% shock, not only are you not contributing, you actually have to withdraw out of it to fund your retirement, and you have to sell out of your assets at those lower values. Now, the problem is pretty clear then in that case. A market shock is much more detrimental to a retiree than it is to a younger person. So when it comes to constructing a portfolio for your clients who are retirees or approaching retirement, the key thing is that we need to very delicately balance the need for growth assets and the need to manage sequencing risk. Now, The other problem that is fairly common in the world of advisors and their clients is being able to answer the question of how much can your clients safely withdraw out of your portfolio in retirement each year. Now, there are many calculations out there that will give you that. So there are very simple calculations that give you a safe withdrawal rate. There are research papers that talk about the safe withdrawal rate. There's a 4% rule, there's a 6% rule. There's quite a lot of research out there. So I was really excited last year when we launched our own Smart Shield simulator tool that does exactly this in probably the most complicated way that you can think of. I'm a numbers guy, so I obviously loved it. And I'm obviously really biased, but the tool itself is so pretty and it's so easy to use. And it's got to be the prettiest and easiest to use thing to ever come out of an actuarial firm. And the reason for that is because we hired external designers who work really closely with our actuarial team, and then they chose to reject pretty much all of my suggestions. So, this is actually not the screenshot of the tool. It's charts that I made. So Neil's probably going to be really annoyed. Our head of marketing is going to be really annoyed that I didn't actually put a screenshot here. But what we managed to do with the tool is to actually run 5,000 stochastic scenarios in real time, calibrated to current market events, current market environment to essentially project out the balance of any individual client's retirement portfolio and calculate measures such as sustainable withdrawal rates, the expected longevity of their portfolio, as well as expected shortfall and all of that. So a couple of outputs that I want to show you here. The first one is probably the most interesting. We call it the safe withdrawal rate. The key word here is safe withdrawal rate. Like, how do you define that safe? So in this case, we define it as a certain level of income that you can withdraw in retirement, having it increase with inflation each year, and have it be met with 90% certainty to life expectancy. And at the same time, in the event that you fail to meet that, we have a cap on the maximum shortfall of about 5 years. Now, under that measure, what's really interesting with this first chart is that you'll find that the aggressive portfolio and a moderate portfolio actually leads to the same safe withdrawal rate. And the reason for that is your growth portfolio actually introduces a large amount of uncertainty. And because of that uncertainty, you can't safely withdraw as much income as you expect. Now, the interesting thing here is that the balanced portfolio actually has the highest safe withdrawal rate. And the reason for that is because there is that sweet spot between balancing growth and balancing risk. And that's what you see in that chart there. And in the second chart is where we look at somewhere in the middle of the distribution. So you're looking at averages. So we're looking at the average estate or average bequest at a certain age, and there you'll find what you expect. A growth fund is going to give you the largest average bequest. So it's going to give you the best average outcome. Now, if you just look at the first two charts, you think, well, let's just go all in on high growth. Like, it seems like the way to go. But the key thing is we need to peel it back and look at what happens if we have a market shock. So this third chart there shows what happens to that safe withdrawal rate after a GFC-style scenario happens. Now, in that scenario, you see that the additional growth assets in your aggressive portfolio has actually taken a 40% hit. It actually has a 40% impact on your income for the rest of your life. Now, the moderate portfolio, the reduction is only 15%. Now, the key thing here is that you just got to manage that amount of growth assets and the sequencing risk that comes with it. Now, what do we do about that? There's many solutions out there. Diversification, I have to talk about it just because I won't spend too much time on it, just because it's been done to death. Everyone does it. Everyone uses it. We use it in our portfolios as well. But look, unfortunately, over the past two crises, diversification has more or less failed. Both in 2008 and 2020, most asset classes fell along with equities. And in 2020, so last year in COVID, it was actually a little bit worse than it was in 2008. And that's just because interest rates were already low, so fixed income wasn't able to provide that same level of buffer it did back then. So, the key thing here is that diversification, it's valuable. There's a place for it, but in this low rate environment, you don't expect it to be as effective as it was before. So if you're thinking about managing risk for retirees' portfolio, then you need to be able to complement diversification with some of the other solutions here. And that's where Milliman comes in. So we've, as of Feb last year, we launched our Smart Shield series of model portfolios. They're now available on Hub24 and NetWealth. When we constructed these portfolios, internally, our objective was actually just to create the simplest and cheapest wrapper for a solution to address this retirement problem, very specifically to address this retirement problem. When we thought about that, there were three key things that we wanted to address. The first of all was instrument selection, then was managing the sequencing risk, and finally increasing that exposure to growth assets. Now, on the instrument selection side of things, as you know, Milliman is not, we don't stock pick, we're an actuarial consulting firm. So our approach there really comes from our experience of working with life insurance companies. In that world, the whole concept of manager selection, stock picking, unfortunately it's not systematic and it's not predictable. So because of that, we can't model that. And the only thing that we can actually model in that world is fees, because fees is a known quantity and we can model that. So when it came to constructing the underlying instruments, we went down a very simple approach of selecting liquid, low cost, and passive ETFs to construct that core. Now, on the second point around managing sequencing risk, as I mentioned before, managing that risk for retirees is extremely important. So that's really where our expertise really comes in, and it just made sense for us to include that element. So what we've managed to do there is essentially include the same type of risk management strategy that we will implement for life insurance companies and wrap it up into a unit trust. And the benefit of wrapping it up into that unit trust is then advisors can then get in and out of that risk management by switching it on and off. And within those unit trusts, we're holding cash and futures contracts to dynamically adjust the exposure to equities based on the level of market volatility and the trajectory of the markets. It's entirely a systematic rules-based approach that's designed to be repeatable and predictable. Obviously, since we launched the models in Feb, it was odd timing in that we launched it literally a week before COVID started, and we were able to show that the risk management strategy did actually work. So in the high growth portfolio, we reduced the max drawdown from 20% to about 7%. Now, the third piece of this of our approach here is that tilt towards growth assets. As I mentioned before, retirees need exposure to growth assets. So within each of the models that we have, we've actually maximized the tilt towards growth assets. We've maximized to the point where if you go any further, you're going to move up to the next risk profile. Now, and the benefit of that is now we're giving the clients the best possible opportunity to tackle that longevity risk. And the additional risk that comes with it, we're okay with, just because we're managing that with that built-in risk management piece. So I'm going to wrap it up there. And I'll pass it off to Lucas.
Yeah, thanks, Victor. We'll have some Q&A at the end.
Cool.
Thanks very much for that. Please thank Victor. And I'll call up Andrew Lowe, Head of Technical at Challenger, to give his presentation.
Thanks, Matt. And good afternoon, everyone. A pleasure to be talking with you this afternoon. A whole lot happening in the retirement income space. If I look at 2020, the Retirement Income Review, a research piece that offers us substantial insights into the challenges that advisors are faced with in terms of providing retirement income, and certainly in terms of a way forward. We see, I think, some really interesting insights into the solutions that will form part of the set of available tools that you have at your disposal in the months and years ahead. Certainly a lot of talk of longevity solutions, and I'm going to talk to you about the application of one of those. And I appreciate there are plenty of choices in this particular space. If I look at the ways that you can address longevity risk, plenty of ways of addressing that, from an application of a safe withdrawal methodology all the way through to ensuring some or all of that particular risk that your clients are exposed to. And I thought it appropriate to share with you one of the mechanisms that you have in place today to solve for that. I was chatting to to a number of you over lunch, and I always think it's interesting when I talk to a lot of advisors. There will be someone in the room that would ordinarily start with something along the lines of, I last used an annuity when they were 100% asset test exempt, which is a while ago now, and I thought I'd very, very quickly recap application of what I'd refer to as a modern annuity in this particular space. So no long-winded explanation here, but broadly, single premium in return for income payments that last for life. There's a whole lot of product solutions in this particular space and a lot of product options in this particular space. But if I look at what the core proposition is, a defensive component within a particular portfolio that matches income payments to the life of a particular individual client or client couple in those circumstances. What do I think it offers with that in mind? Rates competitive to other defensive alternatives, and I'll come back to that perhaps in the Q&A with any questions around that. And certainly I'd ask you to ask that question in a low interest rate environment, how you value the benefit that a lifetime income stream can provide, and questions about how it stacks up relative to alternatives in the current environment. I'd also highlight a couple of things. These are different. You know, the traditional Invest Today giveaway all access to capital. There's been flexibility introduced in these, death benefits introduced in these, different ways of indexing payments. You can link these things to CPI, the most common way of doing it, but certainly also increased flexibility these days with linking to things like changes in cash rates. And certainly you would have seen competitors in this particular space and us starting to talk about linking payments to alternative indices as well. So linking payments to changes in growth assets as well. Entirely possible under more flexible rules that the government introduced a few years back. I'm going to focus in one particular application of a lifetime income stream, and it's to underpin what you do with the balance, the vast majority of a client's assets. And it's to ensure that in the worst case scenario for a particular client, where they end up in a situation where they've depleted all of their other assets. And effectively what I'm ensuring is that in those circumstances, clients aren't dependent on just the age pension alone for all of their income in retirement, because $37,000 a year for a couple or $24,000 a year for a single in terms of total income is doing it tough. And there are ways that we can see advisors implementing solutions that can ensure that their clients are better off in the worst case scenario than that. We hope for the best, but can absolutely plan for the worst in terms of ensuring that those clients can meet their essential spending requirements through their retirement. I've been asked as part of this presentation to specifically address one element. How might I use a lifetime income stream with other assets? And I thought I'd share with you a couple of ways that I've seen licensees applying lifetime income streams. Here we've got two alternatives. These are used by two different licensees. They're different work that we're doing with these licensees. Go to a place like IOOF, and Matt and his team have created retirement income frameworks that suit a whole range of different clients. Other licensees don't have those sorts of resources available and might apply a different methodology for application of a lifetime income stream. But I thought I'd focus on two. The first one on the left is a really, really simple application of a lifetime income stream. And it is for a licensee that decided that their clients would have a higher fallback position than the age pension alone. And the level of income that they set that up was a modest level of income. It was in fact asked for modest as a target level of income. And effectively their rule of thumb in terms of allocating to a lifetime income stream to ensure that clients met is a really simple one. This changes with pricing over time. It started out lower than this, but effectively for clients less than $250,000 worth of assets, there's no allocation made into a lifetime income stream. Full flexibility via an account-based pension or other assets held in those circumstances. For clients investing between $250,000 and $900,000, there was a decision taken to provide a certain level of guaranteed income, and that guaranteed level of income was sufficient on top of the age age pension to meet ASF for modest. And depending on the pricing, that's somewhere between $80,000 and $95,000 for a single or a couple. And effectively, that decision was taken to allocate that amount to ensure that come what may for those clients, irrespective of how long they live or what happens in investment markets, they've got ASF for modest for as long as they live. And then beyond $950,000, the methodology was effectively that we might need a little more to meet essential spending requirements, so we'll allocate more. And effectively a 10% rule was implemented there. So really simple basic rule that ensures clients have a higher landing base if assets are depleted. The one on the right's effectively a matrix for allocation, and this uses something like this concept of safe withdrawal or safe spending that was introduced in our earlier session. And effectively what we do here is we take different levels of assets and we work out how likely those levels of assets are to provide various levels of income. And we might come across, a client with a very high level of starting assets who wants to draw proportionally a very small level of income. Really, really simply, they don't need to do anything in terms of their longevity risk. They're not going to run out of money. Come what may, just do what you ordinarily do in those circumstances. And then you get the blue zones on this particular chart. So higher levels of assets, smaller levels of drawdowns, no need to implement a dedicated longevity solution in those circumstances. And then you'll see the red zones or where there's no colour there, and that's quite simply the opposite end of that spectrum. Client comes to you with $200,000 and says, I want to live on 80 grand a year. We can live on 80 grand a year for a couple of years. It's going to be spectacular, but then I've done my dough. Got absolutely nothing. So, I've got a group of clients that I can't do anything for at that end. And then we've got the clients in the middle where we can improve the certainty of achieving their desired level of income as well as essential spending requirements by allocating an amount into a lifetime income stream. And that's effectively the methodology that we apply there. Different levels of allocation for different clients drawing different levels of income, but effectively a matrix that works out as a rule of thumb, then using tools like have been introduced to refine that for that allocation in those circumstances. I won't dwell here, but I'd ask, when I certainly look at, discuss allocation into lifetime with advisors about the benefits that a lifetime income stream can bring, I'd look beyond certainly the first year's payment out of a lifetime income stream. Look what it does from a total portfolio effect. What does it do when it blends with other assets? How do I blend it with other assets? Very, very different ways that I see advisors doing it. And then I'd ask a few other questions. What other benefits can it provide? For some of your clients who are Social Security sensitive, a partial means test exemption could improve age pension outcomes. For those clients with high net wealth, not a consideration. But for some clients, at some point through their retirement, that will be a consideration. I'd also ask what it does from an estate planning perspective or in terms of impacting my liquidity. How does a portfolio with an allocation to a lifetime income stream compare to one without? And certainly plenty of tools to help with that in mind. I'm going to stop there.
Thank you, Andrew. Lucas, Head of Lonsec Investment Solutions.
Thank you very much, and conscious of time. How much time have we got? 10, 15 minutes. Okay, let's keep it sharp. So, look, today I really want to focus on a couple of things. One is very briefly give you a bit of a outline of our broad framework for constructing a retirement portfolio. Some of you may have seen it or familiar with it, but I'll just recap that. But I think the big thing I wanted to focus on today, and we are talking about managed accounts here, is, what value can managed accounts add to clients? And there's nothing like a good market dislocation to bring that out either positively or negatively. And I think the events that we saw last year in March and April and onwards, certainly for a lot of the managed account practitioners, the guys managing portfolios, and certainly speaking to a lot of the platforms out there, there was a lot of portfolio activity because there was a lot of opportunity. But if you recall what the market was like, it was pretty much bang, bang, right? So if you weren't quick, if you couldn't implement quickly, some of those opportunities were missed and gone, or certainly diminished over time. So I think it's a great test case for managed accounts in general in terms of the ability to add value to end clients, not just obviously from an advice perspective. So I'll touch on one example. I won't go through this, we've pretty much talked about what the risks are. But in terms of framework, and this will lead into the example, but we effectively, we've been running managed accounts from a specific retirement portfolio now for, as a managed account structure for over 5 years, and we've run it as a model for longer. Put very simply, we sort of stepped back and said, what are the key things we want to achieve? As a retirement portfolio, what are the key risks, the key objectives? And put simply, yes, we want to generate income. But I think the other part of the equation is there's very specific risks that are amplified for retirees, and the gentleman prior me obviously touched on some of those things, but certainly market risk, inflation risk, longevity risk, all relevant. So how can you start thinking about portfolio through the lens of those objectives and the risks in a more cohesive way? So we've effectively put these functional lines within our portfolios and say, well, what are our income assets? And it's not just fixed income, but what's that broader pool of income assets that we can use to generate income? Growth is growth, so obviously equities. But then what are some different assets that we can use to help control for risk? Things like inflation risk as an example, because generating real returns is important, certainly for all investors, but certainly for retirees where they're after those real returns. And it's obviously very topical at the moment where talk of inflation, and there's different views in the market, but increasingly we are hearing about inflation risk and what does that mean, and how do you start hedging about in terms of that risk. But in terms of we think about income, and that's the one I wanted to focus in on because it's a good, interesting example if you think about it through the COVID lens. So last year, if you recall, COVID hit, we saw fixed income assets basically freeze up. At the same time, as sort of that period followed on, we saw a lot of companies on the equity side, a lot of those loved companies that many advisors out there, and we all probably invested in, a nice, stable income, nice dividends, all that sort of stuff, suddenly started cutting dividends, or suspending dividends in some instance. And I remember at that time we sort of ran a bit of a model and say, well, what's going to be the impact on our portfolio? And ballpark figure, we thought, well, maybe we're going to get a reduction in dividends of about 30%. That was sort of what we factored in at that time. Also at that time, we were thinking, well, what are we going to do from a portfolio perspective to generate income and maintain income? Fortuitously, at that same time as we saw that happening, we also saw massive dislocation in credit markets. So if you recall, and this is looking at bank loans, syndicated loans, we saw spreads blow out by about 6%. The market was factoring default rates of around 20%. To give you some context, in the GFC, the sort of market was factoring defaults of 10%, so pretty serious stuff. Obviously, markets were frozen in terms of fixed income assets. So a lot of scary stuff. But at the same time, most of us that were talking, different managers, were saying actually there's big pricing dislocation. And if we see that liquidity come back into the markets, it's a great time to capture some of that mispricing that we, not only us, but a lot of people saw in the market. But to put it back into the context of managed accounts, and implementation is never a sexy thing to talk about, but if you can articulate how much that adds to an end client's outcome because you are in a managed account structure. And this was a perfect example. So it wasn't our expectation, but that opportunity pretty much closed up fairly quickly. You had probably, several months, and then you saw spreads come in. We decided, and you can see there on the end of May, we went into at that time, it was the Bentham Syndicated Loan Fund. I mean, you could have gone to a number of different strategies. We decided to go there. We did see a lot of dislocation in that part of the market. And then we got out probably, mid sort of December. So you can see that short time frame. So yes, we got it right, great, but that's not the point. The point is, if you weren't in a managed account structure and you were running and you've got a big book of clients and you've got to go through your clients and, who's your favourite client? Is it the one guy that starts with A or Z? The reality is, by the time you would have implemented and not only sent out that advice, but the client in some instances come back to you, a lot of that opportunity would have missed out. Maybe you'd have still captured some of it, but the reality is you would have missed out a lot of it. So I just thought it was interesting, a nice little test case to really articulate what value managed accounts as a structure can bring to clients, and something that's very quantifiable in terms of the implementation benefits. And I think it's something that more and more we should talk about, because it is I think it's one of the things, certainly as a portfolio constructor, as an investor, it's really highlights some of the benefits. So I'll leave it there and we can go on to Q&A.
Yeah, thanks very much, Lucas. Please join me in thanking Lucas. So we've got a little bit of time there for Q&A. I'll probably just make some further comments. I think certainly at IWF we really believe, the advisor is very important in the retirement income conversation. I've got some stats, and these numbers add up to more than 100 because advisors use a range of approaches, but some consulting firms have stated that cash bucketing, 50% of advisors use a cash bucketing type approach. That's interesting. 46% use some sort of conservative asset allocation approach to fund retirement income. 26% use an income type asset allocation approach of some sort. 38% using longevity products. And 11% are using the same approach as the accumulation portfolio. So a bit of a mix of approaches there. If we haven't got any opening questions, I'll ask one for Victor. Victor, in terms of implementing that risk-managed approach, how are you logistically actually doing that? Is that some sort of short futures?
Yeah, that's right. So what sits in those even keel units, or what sits in those unit trusts that the Smart Short portfolios invest in, is cash and futures. So we're trading the most of the liquid exchange-traded futures contracts on the major markets. And the way we do that is we essentially dial up the amount of futures we have in those unit trusts depending on market conditions.
Okay, and are you targeting some sort of volatility outcome or a drawdown outcome?
Yeah, so
how do you do it?
Yeah, there's two objectives as part of that risk management. One is to target a certain level of volatility, and the other objective is to minimize the impact of sustained market drawdowns. So as markets start drawing down, you start layering on more and more hedges.
Okay, thanks, mate. Lowy, so there's a lot of depth in all of the presenters today. I think they've presented some initial ideas there. I know there's a lot of depth you go into, Lowy, in terms of that 95,000 allocation. I was interested there. You've got that as a core to hit an income goal, but the same amount for 250 to 950. All of that cohort, you're putting the same amount into that base level.
That was essentially designed to target as for most as the level of income sufficient to make that. That broadly works for clients between, say, 66 age pension age and 76. It starts to get a bit skewed as we move away from older clients. It's also a little bit different if you get clients that are wildly different in age for couples. But effectively, that allocation gives you, in addition to the age pension, once you get your assets down to full age pension level, appreciating they're going to have very different profiles of age pension through the first decade or 20 years or 30 years of their retirement. But once we get to a core level of age pension, we need the same amount on top of that to get to as for modest.
The other nuance I pulled out of that, and I'll probably need a magnifying glass to look at the coloured table, but you're recommending a risk profile for the account-based pension, one risk profile notch higher for that middle cohort, but for the others, it's not doing that?
Yeah.
So you're taking account of the risk reduction from using annuities?
We do. So in that particular approach, and this is a conversation for licensees and advisors to have around the way that they appropriately will place a portfolio with a lifetime income stream versus one that won't. And effectively, what we're doing is looking to maintain broadly the same level of growth assets in a portfolio before and after an allocation into a lifetime income stream to ensure that there's no de-risking of the portfolio. And that's why in some of those, there's a step up in the allocation to growth assets in the residual assets.
Lucas, you talked about some of the risk premia there. Do you do factor analysis in your portfolio construction process, and how do you think about that in the retirement income models?
Yeah, so just in terms of like the value factors and all that sort of stuff, yeah?
Yeah, the risk factors, I guess inflation and...
Yeah, look, I say in terms of the broader factors, absolutely. So we do look at it in a couple of ways. So one is we look at it from, I guess, as part of our dynamic asset allocation process. So what are the key risks we're seeing more broadly? So inflation is a good example. We have been implementing some exposure to linkers, inflation-linked bonds, just as a bit of a hedge from that perspective. So yes, we look at it from a risk perspective, but also then we look at it in terms of making sure we've got a diversity of strategies within the portfolio. So again, if I sort of look at the income part of the portfolio, yes, we have some equity strategies in there, but really looking at ensuring that we sort of have a diverse source of income so that, you know, and again, if we look at the example, if you were just relying on divvies, I mean, we've bounced back now, right? But if you were just relying on dividends, and we saw that peak back last year, you know, you probably caught out a little bit. So having that diversification and ensuring, you know, that it's not just dividends, you know, are there, for example, things like those certain parts of the credit market at that point in time. So it's a fluid process and you want to ensure, and so the way we do it is we'll flex the portfolio in terms of the sort of factors depending on where we are in the cycle.
Are there any questions from the floor at this point? Surely there's one or two.
I've got a question for Victor, which is, you didn't mention it, but my understanding is that the even keel funds are basically targeted at ASX 200 or MSCI ex-Australia as a kind of block allocation within the portfolio. A, is that right? And B, does that mean that the exposure to the even keel funds kind of can rise or fall depending on the risk profile of the portfolio?
Yeah, that's right. So each of the models will have an exposure to Aussie equities and international equities. And then as part of that, for Aussie equities, you will have an allocation to these even keel domestic units. And for the international equities, you'll have an allocation to even keel international units. The two sort of pair together. And the idea is, if Australian markets get more volatile, the even keel units will increase their hedges to the Australian units, and if international markets get more volatile, we do it separately.
So it's sort of a follow-on question, which was that one of the conversations which came out of several of the previous presentations was a sort of increasingly nuanced approach to asset allocation, treating, China, to take an extreme example, China as a separate case in emerging markets, for example. So can you see the scenario where you develop these tools that are then applicable against sort of more nuanced asset allocation approaches?
Yes. I mean, certainly. Like right now, we have these two units designed for a broad market, the Australian market and the international market. Going forward, there's obviously scope to introduce these types of risk management solutions for more specific individual markets. Obviously, China will be an interesting one. It's just the difficulty there is the accessing reliable derivatives in that market that are liquid and easy to trade and will continue trading when markets are in turmoil. So that's one of the limitations on some of those markets that we've encountered.
Other questions? Considering this is the fundamental role that most advisors perform, which is retirement incomes, it seems to me this is, what we've seen here is three really interesting approaches to facing a set of risk-based problems. So how do you think this approach to the retirement income goal will evolve?
Look, we are seeing, I guess from a product perspective on the research side of our business, we are seeing more and more different types of products looking to address this issue in different ways. It's probably fair to say but innovation has been slow. Part of that has obviously been just getting it through sort of regulation and so forth. But it's a structural issue. It's not the only one, but it is a structural issue. So I think you are going to see new products that are trying to address some of the risks, particularly around sort of drawdown risk. I think that's certainly, we're seeing it. From a strategy perspective, I think it's really just, it's not ripping the Band-Aid off and changing everything. It's just gradually improving things. And that's the way we approached it. Our sort of strategy initially came out of, we worked with a lot of clients that were running retirement strategies. Some were using bucketing strategies and a variety, and it was, none of these things are fundamentally wrong, but how could we build on that and maybe address the issue a bit better? So that's, I think it's a gradual thing rather than this massive revolution.
Any other questions from the floor? Might have one for you, Loie. You talked about a lifetime annuity and a reversionary annuity in your presentation. What about deferred annuities, and how do you think about that in the context of your frameworks?
Yeah, I think the flexibility that the innovative super income stream rules allowed from a couple of years back, I think has been really interesting in giving you additional tools in your kit bags. If I present something like I presented today, and you say, I like the idea of protecting as for modest, but I don't want to talk about 80 grand worth of allocation into a lifetime income stream. What can we do differently? I would absolutely start to have a conversation around deferral. If I could give you an income stream that starts when you think you're unlikely to have assets left, whether that be 15 years down the track or 20 years down the track, what we take immediately as a trade-off for that is lower initial capital involved. Effectively, if you're confident that you can get a client through the first 10 or 15 years worth of retirement, a 10 or 15 year deferral on a lifetime income stream can markedly reduce the amount of capital that you're required to invest to provide the same level of income thereafter. And I think that represents a really interesting alternative. So instead of a 10% allocation, we might be talking a 3 or 4 or 5% allocation into a lifetime income stream, leaving us 95% plus to do what you have historically been doing. So if I look at a DLA in its truest sense, it is the most efficient way I can give you pure longevity insurance for your clients today.
So for something like a 15-year deferral, I know annuity, everyone, first objection I hear from an advisor is that, annuity rates are so low, but for a 15-year deferral, what would be a ballpark type of rate that you'll get in 15 years' time? At
the point where you start going beyond 10 years, you start to halve the capital involved in that. In 15 years, I don't have off the top of my head, but if anyone's interested, onto a calculator this afternoon and you can run the numbers and show exactly the effect that a 15-year deferral has. If I look at the way that we see clients apply them, the vast majority of clients that have chosen to invest in DLAs up until this point have chosen quite short-term deferral periods. Now, these 1, 2 or 3 year deferral periods, they look to me like an immediate annuity with a slightly sexier rate. But if I go out to a 15-year or a 20-year deferral, I think you've got a very different product proposition. And I think you are then buying some longevity insurance. And with long deferral period, it becomes very cost effective.
Okay, please thank our panellists today, Victor Huang, Andrew Lowe and Lucas Taporbe. Thank you.
Well, thanks very much, gentlemen. It was a good session, and I think I was just reflecting back. If you were in the industry or the profession back in the early 90s, I can recall when interest rates were going nuts, advisors being really upset. Well, they weren't necessarily advisors then, they're insurance agents being really upset when they were locking in interest rates for their clients on lifetime annuities at sort of 12 to 13%. And, I can remember having arguments with insurance agents at the time who weren't happy with that because their clients were really only happy if they're getting 20 plus. They're getting ripped off at sort of 13 and 14 for life. But hopefully some of those stuck, and maybe there's a handful of very happy clients out there. We're looking at the timing and we're thinking if we were running a railway in Japan, we all would have been sacked by now. Running a little bit behind time, but we're saving the best for last. So this is our final session just with our roving, and it says asset consultant, but actually Jerome's a portfolio manager. He's not an asset consultant. To give his views on where growth can be sourced for the next 12 months in 2021, and then we'll move from there to a panel discussion, which I'd urge, given it's the last session before drink, I'd like it to be as controversial as possible, really. And so if you guys aren't going to throw difficult questions in, we'll just stir it up here on stage and see if we can't make it happen. So our next presenter is Jerome Lander. He's a portfolio manager. He has been investment consulting, but that was quite a while ago. He's been a chief investment officer over a long history. And I found out when I read his bio, actually trained originally as a medical doctor, which is good. But he did say to me that perhaps if there was first data in the room, they might have more recent experience. If anyone has a problem, that's his disclaimer. Please welcome Jerome.
Thanks, Alan. Good afternoon, everyone, and thanks for that kind introduction. I might have to resuscitate myself, that'll be the problem. But now, Alan has given me carte blanche to be really mean to the audience today, so I'm going to pick on somebody. I'll pick on Bill because I can read his name tag. Bill, what do you think, what do you think diversified funds, what sort of return do they normally get? Multi-asset funds, diversified funds, managed account funds spread across different asset classes. What sort of return do they get, do you think, normally? What about historically? Really? You sure about that? No? Good. You're not right. What about anyone else? What about Pierre? He's on his phone. Pick on him. What sort of return to diversified funds or managed accounts, diversified managed accounts, multi-asset funds, multi-strategy funds, they're all the same, right? In one sense, in terms of what they're investing across. What sort of return do they get normally in the last few years? Last few years, per annum. Yeah. So, the returns you typically see out of all these things, no matter which way you structure it up, is like 3, 4, 5%. These sort of returns, right? Really low, right? And these represent the sort of returns we give investors, and often really fall short of what people actually need, I think, to sort of meet their objectives and their outcomes. And part of the reason for that, and I'll touch on this in my presentation, is that we structurally, of course, have set everything up, wrong in the way we think about things through this, these strategic asset allocation type approaches, and they really constrain us from being able to use basically all the tools we've got to actually create great outcomes for clients. We constrain the asset allocation, and we constrain the ability to select strategies and to move things around. So once you constrain top down and you constrain bottom up through, restricted access on platforms, etc., you really haven't got much left. So what you see is hence a quite predictable outcome every year from just about all the things we produce as an industry of quite low returns. And I'm not sure about you, but I personally don't really want to invest in that stuff. So I'm an outcome-based, absolute return, multi-asset, multi-strategy type portfolio manager. And, a big part of what that means to me is that I'm actually really interested in what the client outcome is. I'm really trying to create portfolios which better match what clients are looking for and which are better able to use all the tools we've got to actually create those outcomes. So dynamic asset is I'm the portfolio manager there, where we have the managed account, daily retail priced, probably long track record, 8 years of history, basically building numerous different portfolios to match clients' objectives across super and retail. So you'll be familiar with a lot of those things from others. And I'm basically started a diversified alternative fund at Lander, which actually is to basically in large part invest my own family members and friends' money, so that it gets much better outcomes from a diversified strategy. And what I'm looking for there, to give you an idea, in contrast to what you normally get from a diversified fund, which is you basically never get 10% returns, is 10% plus per annum in terms of my return target, with much lower vol than equities and much lower drawdowns. So in my view, that's the sort of stuff people actually want for their money, and why don't we go about producing it? So I have, and I think there's a big need for that, and it may be of interest to some of you in the room, so I'm very happy to talk to you about that later if you are interested. Obviously. So this is, obviously these are my personal views. They don't represent the views of any associated party that I'm working with, and obviously my views are subject to change, just like my portfolios are, and hopefully they're well researched and forward-looking, which again is a very big difference from what we generally see in the industry, which are backward-looking sort of approaches and very much with very strong status quo bias, right? So Basically, I'm not giving you personal advice. You can, I'm talking to wholesale investors, but and there's my disclaimer, I think, as much as I can put it out there. So the point I'd make is that traditional portfolios, despite this massive ramp up in markets, right? We've seen interest rates go from high to low. We've seen huge equities prices, and yet we still get all these diversified funds, which are equity dominant, producing all these mediocre returns. It's just amazing when you think about it, right? But the point I'd make now is we are seeing a significant change in the market environment. We've got very big risks in markets from traditional assets. We know, and we've talked about this today, we heard this today a lot, geez, cash and bonds, they're stuffed, aren't they? There's no return, right? So on offer, really. So what do you do? And that's why these SAA portfolios are so tremendously challenged, of course. It's just obvious, right? So you can't sit hand on your heart and say that you're doing the right thing by stuffing people into that, really. So what we see most people doing, of course, and we see this across, it's an amazing time in history because we see so many people across different market segments across everywhere basically overweighting equity risk because they think there's no alternative, right? Where do you go? You just got to be all in on equities, basically, or as much as you can possibly stuff into the portfolio. And, the problem with that is if you're simply concentrating into index-like volatile assets at high prices, in a bubble created by, central banks and monetary policy being where it is, like you're just waiting, you're potentially waiting, you're sitting on a disaster, right? You're just waiting for the train smash. And we've talked a bit before about market structure, whereby the market's actually very vulnerable because we've got a whole bunch of index-like or index investors actually, or index-like, right? Really very similar to that, which basically buy on the way up and they'll sell on the way down, all together as a herd, right? We don't have a lot of diversification out there in terms of what's there in the sort of constituency. And we saw this in the GFC, by the way. We saw high-risk credit just collapse. Why did it collapse? Because there wasn't the right spread of investors. The people who were buying the stuff were all selling at the same time, and there was no one to buy it, basically. And so this is a situation we've seen before in markets. And I'm not saying it's going to happen, by the way. I'm not. I'm just saying it could. And the fact that it could happen for a prudent portfolio manager is enough. It means you have to have some risk mitigation against it, and you need to think about it when you're building a portfolio. And as an industry, we're not. So the point here is that if you're not thinking more broadly, then you've got a significant risk of having large losses, and you're not actually, you're not obeying rule number 101 of markets, which is, you've got to diversify, right? Diversification is a free lunch, right? And we think we diversify because we're using some traditional approach, which was good for diversification in a certain market environment. When bonds and equities had the nice correlation benefits. But go back further in history and guess what? They didn't. And go forward from today and guess what? They may well not. In fact, it's quite likely they won't because of where yields are at the moment and the risk being to the upside with inflation and interest rates actually moving out of that cycle of lower interest rates into a different environment, even if they just stay stable. So, where's the growth, right? This presentation is not meant to be about how miserable everything is. It's meant to be about, where's the growth opportunity out there? And, there is growth. There's plenty of growth opportunity out there. And part of it's due to these problems that I've talked about. There's actually greater growth opportunity in active management. Huge growth opportunity in, looking at bottom-up strategies and finding huge alpha potential, right? Huge value-added potential. I mean, I'm looking at plenty of things from around the world, which I honestly, hand on heart, expect to achieve 10% plus outperformance of a reasonable sort of risk-adjusted benchmark. Like it's just, that's just outside most people's framework. They go, oh, gee, I got 1% alpha or 0.5%. You see people modelling it up on their presentations. Oh, yeah, great. Terrific. Very exciting. But there's actually a lot of opportunity in active management, right? If you're actually prepared to do the work and look. And guess what? Most people aren't again. So it's a structural issue. They're not set up to do it. But you've got to go out of your way, right? You've got to have a particular difficult personality and be very stubborn and actually be wanting to do this, right? Be wanting to actually go out there and create value. Be motivated by actually creating that value and doing the work, working your ass off. It's actually really hard work. Not everyone's cut up for that. And you've got to have the skill base. You've got to have the training to do that. Why are these opportunities there? Well, in part, like I said, because of this historic policy manipulation, the huge capital misallocation we're seeing in markets, the huge numbers of, one-sided sort of investors, passive benchmark-orientated institutions, the ones with all the money, doing all the same stuff together as a herd. And, rampant on the other side, we've got rampant leverage sort of retail speculators. We saw GameStop a few weeks ago, right? Just ramping the market up. And now, is anyone going to argue that GameStop was efficiently priced? Now, GameStop just about took down a whole bunch of sways of other markets, right? It was pretty close. You know, this is this sort of vulnerability that exists in markets. It's showing us that, right? These markets aren't as safe as they look. So, you know, all this price insensitive buying and selling and trend following and momentum, etc., and no one really actually valuing an asset, etc., or looking at what makes sense and being prudent, you know, does create a lot of distortions. I see it, huge distortions. You know, the problem is, when do those distortions close, right? You know, when does the bubble collapse, right? We don't have the answers to everything just because we're adopting this approach. So there's also, as I mentioned, the growth opportunities in diversification, right? So getting genuine diversification really requires you to look outside cash and bonds, and you do need to use alternatives. You do need to use active management. That's how you get the diversification these days. You do need to use a whole bunch of other strategies which are much more sophisticated, which frankly aren't on the radar of most people who would just think there's no alternative to equities, when in fact it's in the name what the alternative is, as we all know. You know, in a low returning world, in other words, you know, when mainstream assets have got low predicted returns and high risks, the best growth investments just can't depend on simple plain beta market returns. You're just not where you're going to find it. So you need to access these opportunities. As I mentioned, you need a broader opportunity set. You need the willingness as well to move your asset allocation. Like, you know, I saw a write-up the other day on LinkedIn, and, you know, a big institution was basically, you know, promoting themselves. They'd moved their asset allocation. They picked the bottom last year. You know, they did great things. It was great timing. They were very brave. And they were. In the institution they worked at, they were very brave. You know, they moved their asset allocation by about 3%. You know. So they got it right. It was great. You know, they got to crow about it. But did it make any difference to anyone, do you think, really, in the big scheme of things? Like, you have to actually be prepared to move your asset allocation a lot. A lot. You know, 20, 30, 40, 50%, not 3%, right, if you want to make a difference from asset allocation. So you need the setup to be able to do that, right? You need the mandate. And you also need the best bottom-up active management, right? Like, look, a lot of the times the best people, right, they don't go into manager selection or strategy selection, as we all know, right? A lot of them go into sales earlier because they think it gets paid more, right? If they ever get to research. Maybe they move from one to the other. Okay, so what are some of the specific? Let's get a bit more specific now. What are the sort of some of the areas that we're looking at where we're finding opportunity or we think are interesting and worth looking at the moment, and the sort of examples that we use, you know, where we can in the managed accounts, but, you know, more broadly, really in the Wealth Lander fund. You know, the specialist long bias managers. So there's really some very strong growth opportunities. You know, within equities, it's not all bad within equities, right? There's pockets of exciting, very promising opportunities. There's pockets of very sensibly priced stuff. Equity long short, right? You know, shorting's got out of fashion. There's hardly anyone shorting in markets these days. But that's the opportunity, right, from a longer term point of view. There's actually lots of crap to short too. There's lots of very overpriced stuff to short. There's lots of stuff that takes advantage of the market's, you know, the market's structural inefficiencies. Market neutral funds, event driven funds, lots going on there, in massive amounts of opportunity in event driven strategies overseas. Precious metals, right? You know, why on earth do people not include more precious metals in their portfolio given the macroeconomic and thematic backdrop? You know, we certainly do in the managed accounts because, you know, inflationary risk of, you know, yield curve suppression, real rates need to be low probably in a fairly likely scenario. Very positive backdrop for precious metals, hedges some of those geopolitical risks potentially, a whole bunch of benefits. Commodities, right? Obviously, you know, we're seeing that in the markets at the moment with commodities running. Convertible bonds, you know, quasi-equity type strategies, but with more attractive kind of payoffs. Volatility strategies, right? The time you want your hedging, often volatility is the cheapest, right? Why don't you take advantage of that? Currency strategies. You know, we're certainly seeing a lot of manipulation from a policy point of view in currency. Lots of opportunity gets created by policy distortions. And dare I mention it, Bitcoin or digital assets long short, more than Bitcoin, right? There's a lot more than Bitcoin out there, right, guys? Been researching this stuff for years. There's a lot out there. And it's very interesting. It's a very interesting space. Lots of risks, obviously. And hedging against market exuberance, as I mentioned, you know, like there's the opportunity to actually take advantage of some of the crazy participation out there to hedge some of your portfolio risk. So lots of opportunity. So I think I've mentioned a lot of this. I won't harp on it about it again, but, you know, basically asset allocation, greater alternatives, greater active management. You know, we know what the answers are. A lot of it's just about the courage to be willing to do it or to partner with those who are doing it, you know. Be innovative, you know, be different. have a go. You know, you only live once. The thing I would mention there, actually, is that wholesale investors really have a very different opportunity set from retail investors. And what we see a lot of advisors do is shove their wholesale clients in with retail solutions and retail type outcomes, and they can do a whole lot better. There's a lot of the best products are actually only wholesale in nature. So if you are able to access those strategies, then why give your wholesale clients second best? So if you do all this, so what? What difference does it make? Well, guess what? What's possible? Last year, I ran a wholesale diversified alternative fund. I was a portfolio manager at Leif. I'm finishing up there relatively shortly, and will be focused in the wholesale space on my Wealthlander fund. But what's possible wasn't the sub 10% return from a diversified fund that you used to every single year, right? The fund there achieved a 21% net return to investors, and it did it with a less than about 5% volatility and a 6% maximum drawdown last year, right, during the COVID crisis. And you can see the return profile is actually, was actually pretty smooth, right? You wouldn't know that was last year when looking at that return profile. You would just think that's just a normal sort of positive type environment. So this is not model stuff. This is real stuff that I produced last year as portfolio manager, working with Lucerne. So, they're real returns. They make a big difference to clients, and they're possible to achieve if you adopt some of the things I'm talking about. And I think, I'm very positive about the prospects for this year and beyond. From the active management opportunity set is really amazing. So it's never been better. It's a great time to be a great active manager, and you really should expect to do quite well. So for those who don't know Matthew Walker and Leo Lopez, I just want to point them out because thanks to them I'm actually able to present here today. So, there they are sitting together. Guys, stand up, show yourselves. Don't want to refusing. They're right there. Look at them. No, so if you are an advisor, there's probably a couple in the room, I'm not sure, then interested in managed account, business solution, then that covers everything, super, non-super, that's been around for a long time, a long track record, then talk to those guys. But look, that's my presentation, so thanks very much for indulging me. Appreciate it.
Okay, so we might finish off with a panel. I'll ask Jerome to perhaps grab a drink of water, then come back up onto stage. We'll get Brad Matthews and Chris as well to come up. Chris Leotis. Now on. Okay. Well, I know we're the three of us, the four of us here are kind of between you folks and a drink, so we won't take too much time. But there's lots to discuss. And look, I had a range of questions, but I thought I'd just start with one and then just see how we go from there. And that question is really around risk and not necessarily returns, but risk. And the question is, if there was one message, just one, so you're only allowed one message that an advisor was going to give to their clients around risk in 2021, what would it be? And why? Chris, I'll go with you first.
That risk doesn't have to be seen to be there, I think is the clear one. So everybody thinks that risk has to be seen for it to exist. And we have this conversation quite regularly. And it's happening in every asset class. So people will say, like, I need more yield, so let's look in the bond space and how do I get more yield? So you go emerging markets, okay? So it's giving you a 3 or 4%, 5% return. And until you see that risk, it's like it doesn't exist. Because we're sort of in this sort of inflated world where until a risk actually happens, there's no risk. And so that's the part we're counselling our clients regularly on and saying that just because you don't see it doesn't mean it doesn't exist. It actually does exist, and we have to account for it. And if that means less return, well, so be it. But as long as you understand the risk you're taking. And
just to follow up, do you then have a conversation about what that risk might look like? So they'll say, okay, great, it's because you're not aware, it doesn't mean it's not there. So what is the great sleeper, Chris, from your perspective, if you're going to describe that to your clients?
Yeah, so we will model it using real life scenarios. So we'll use extreme scenarios in some cases. So 2020, March, April, February, GFC, tech wreck, you take your pick. There's plenty of crises you can test something over. But in some cases, you can't test an asset over that period. So you then talk about the qualitative factors involved in that investment. So it might be a liquidity risk, it might be counterparty risk, it might be people risk. So you talk them through that. And once you start talking through that, it's fairly evident what the risk is. And then you get some uncomfortableness in the room. But we're not trying to dissuade them from doing it. We're just saying to them, as long as you're fully informed, we're happy to take the risk. So as long as you know what you're doing and know what risk you're taking, we're happy to execute or assist you with that. But in most cases, they don't understand. Or they think they understand and they don't.
Mm. Jerome, your thoughts?
Yeah, I think, well, obviously I've got an outcomes-based bias, so we're interested in I'd ask them, what's the risk that matters to you, right? Basically, is it your portfolio risk or the risk of being different from everyone else? What's your risk?
Brad, thoughts?
Yeah, look, if coming down to one statement, I think it would be interest rates can go up. From a micro perspective, people with debt, I think, need to be very much aware of that. From a macro perspective, the impact on bonds, the impact on the broader economy when there is so much debt that's built up in the system. And it's been a long time since they've gone up.
Sure has. Look, I might throw in the interest of time, I might actually throw to the room. Are there any questions that are on people's mind? I know Toby has probably got about 4 himself, but are there any questions that are from the floor that are on people's minds? You've had quite different presentations from, if you can recall back. Well, yes and no. When we first set this up, we thought we'd have a reasonable amount of divergence, but I think as I saw you guys present today, I think there are some pretty common themes that were coming through, but looks like there's a question right down the back. Toby's walking through. Yes, okay. Yes, please.
I mean, inflation risk has been mentioned by quite a few of the panellists today, but how do you think about the difference between sort of slightly higher inflation than the market's expecting versus a real sort of inflation taking off and the potential differences in how you build a portfolio to reflect those sort of different scenarios?
Okay. When you do play out the scenarios, they do produce a very different portfolio outcome. So it's one of the conversations we started having with our clients, saying that depending on a range of inflation outcomes and then interest rate outcomes thereafter, the portfolio that we would carry for you would look very, very different. And that's the part that I think is some people are getting a bit concerned about, where in the past inflation hasn't been a concern. So roughly your portfolio setting or your outcomes they mattered, but they didn't change the outcome that much. So in terms of how much equity risk you took, how much bond risk you took, I think in that environment where things get out of control, your portfolio setting is very different depending on how much risk you build into it. So how much you think inflation is going to go up and then what the central bank reaction function is going to be thereafter. That dictates a very different portfolio outcome on each of those scenarios.
Yeah, I'll just add to that. I think that is the key point. It's to what extent does it prompt a response from the central bank? So the Reserve Bank has been incredibly open in terms of its 3-year guidance. If inflation becomes a problem within that 3 years where they have to change that, I think that then becomes a shock to the markets and all assets are affected by that. But it would have to be a reasonably significant increase from inflation from the current level for that to be a problem.
I think the more important issue is, what sort of inflation do we get? We probably won't get inflation of financial services incomes, right? That's what I'm guessing. So I'm not really worried about that. But we could get supply side, commodity type inflation, and we are getting that already. I mean, one thing with all the presentations today, people didn't actually mention. Well, look, we've seen lots of inflation, right? We've seen asset price inflation to date. Now we're seeing commodity price inflation. What's next? Do we see more of the same? Do we see something different? So they're the key issues, the type of inflation, and how you hedge that would obviously be different.
Thanks, gentlemen. Any other questions on the floor?
I do have a question, as it happens.
Thought so, Toby.
Here's one I prepared earlier. No. I mean, we just heard Jerome talk, in his session on where he's looking for growth, talk very largely about an alternatives-based approach, i.e. a non-mainstream approach to portfolio construction. So, to Brad and Chris, having heard one of your, confreres go, right, I'm all in on alternatives. I mean, is that your approach?
Yeah, look, I've got some sympathy for that argument. I think particularly now, in terms of the defensive part of the portfolio, part of that traditional allocation, I think, will be forced into more alternative strategies. Ultimately, though, I still think equities are probably going to be the main source of wealth accumulation for the majority of clients. But I think in terms of having diversification in the portfolio, under the current structure, it's very difficult to get that now without alternatives. And my world's very much the retail world, and the choice of product hasn't been great, and it's been an area of high fees and disappointing performance. I think it is gradually improving, and I've done a fair bit of work over recent months in trying to identify strategies that are robust in terms of the downside equity participation. But look, the choice isn't great, and I think that's been part of the problem in trying to integrate those into retail portfolios at a time when other asset classes haven't done too badly. But they'll certainly stand up more when you get weakness elsewhere.
Sorry, a comment, just did you want to make a comment just then? Yeah.
Just on the range of alternative assets, obviously illiquidity is a huge issue, and I was here at this conference 4 years ago and we're still talking about the problem of integrating them in managed accounts. It just seems to be a huge platform issue that has yet to be solved. When you guys are talking about alts, is it just daily liquid alts? Because, I mean, there's private debt out there that's, yielding 8-10% net, but it's an 18-month lock-up, monthly NAV. Real assets, the same. So there's some excellent choices out there, but you will have to forego liquidity. And in this low interest rate environment, are your clients prepared to do that?
So there's a couple of issues there, and so I'll talk about the managed account or SMA one last, but assuming a non-managed account portfolio, the problem you've got is platform, obviously getting it on platform. So investment's easy, super and pension is incredibly hard still in this day and age. So even just getting access to the investment on platform is difficult. Now, if you're a wholesale investor and you're accessing off platform, no problems, easy. But then the secondary problem to that is research house ratings and whether you're happy doing your own research off your own bat and wearing that risk, which is a big problem. On platform with the managed account, with the movement towards managed account or SMAs, it becomes problematic because with SMAs, we profess, and the industry does, that there's transparency, liquidity at all times, and the ability to manage that portfolio in a very liquid fashion in terms of rebalancing and the rest. I think there was a mention of it made earlier today, becomes incredibly possible, almost impossible to manage because you have to take out that investment from a rebalance. And the longer it doesn't rebalance, the harder it gets. Or you go through a down environment where you want to take advantage of an opportunity, but you can't rebalance out of that asset. And that did come up. I had one client in March that wanted to rebalance out of an illiquid asset for a variety of reasons. My advice was not to, but couldn't do it in a timely fashion. And got stuck with it. So the structures that we are moving towards are problematic, but even putting those aside, assuming that we don't move to those structures, there's still got the platform issue and you've still got independent research in terms of are you happy to wear the risk of that product without a research house rating. So I'm not saying it's a no, I'm just saying there's impediments, the impediment's still there. But we're seeing an increasing massive influx of private equity, private debt products come to market, and with a lot more flexible structures. So open front end and then gated back end, but that makes them somewhat more amenable to getting on platform.
Anyone else on the panel have any thoughts on that or comments they'd like to make?
Yeah, my point was, thanks Alex for that question, but I think it's really relevant, is, if you don't need to have the constraint, then don't have it, basically. If you need to have it, it has to be there. Well, of course you're restricted, right? And it's going to have a cost, as we know.
Fair enough. Any more questions from the floor? Just having a look. Toby, you've got a bunch, I'm sure. You've just one off the top of your head.
Yeah. So look, having had this conversation about alternatives, if we then start to think about the growth opportunities, particularly in equities, is there anything that you go, right, well, that's my safe harbour for the next 24 months?
We're talking listed assets or?
Well, your choice, but I mean, yeah.
So, I made the comment earlier today that, we're fairly bullish in terms of our outlook, and that's just because we think the flood of liquidity into markets, on top of outsized household savings rates, outsized cash holdings in money market funds and the rest. There's just so much cash in the system and so much more liquidity coming that it's hard not to be positive risk assets. And that's just from a return perspective. It's not necessarily that, like I said, that we think they're going to do 30, 40%. It's just that if inflation's a concern, well, where do you go for real returns? Even at a bare minimum. So if cash and bonds aren't going to give it to you. So just a flood of money that's going to come into the market. It's going to be very narrow in terms of where it heads. So we're optimistic on that outlook. In terms of where we're placing that money is probably the more critical question. So where are we dictating where that allocation goes? And that's the part that's more critical. So in portfolios, we're bullish Asia emerging markets and have been for some time, but more so this year. We just think the relative value there on offer is very wide versus developed markets. And then the earnings per share expectations for the next 12 months are actually a lot wider than developed markets. So obviously you wear some currency risk and you wear some emerging market risk by going there. But we're very bullish EM. Now that comes with US dollar issues. So obviously you have to then expect the US dollar remains weak through that period, or the Fed doesn't lose control either way. But we're placing more and more money into Asian emerging markets. And I come back to Jerome's comment, we don't do things in 1% and 2%. That's just not our style. So we're talking outsized allocation to emerging markets in Asia. Within the Aussie equity landscape, I think large cap is probably going to struggle, long only large cap sort of funds going forward, just because the opportunity set's not there. Now, you might argue that value might do well in that subset, just given how bad it's been for the last 12 months. But small caps and mid caps are the place to be and have been for some time. So we're still positive those niche asset classes where there's less research, there's less awareness, there's people trying to apply their trade there but don't really know what they're doing, so hence there's more opportunity. So coming back to Jerome's earlier comment, the more under-researched or the more poorly researched a market is, the more positive we're likely to be, as long as we're comfortable with the manager we're using in that subset or that part of the market.
Yeah, safe harbour for 24 months. Yeah, I'm not sure about that. That's a long time. But the way I think about that then, given the risks that are out there in the world today, and we've mentioned inflation, we've mentioned the big risks, sort of the left of centre tail risk, inflationary risk, geopolitical risk, Taiwan, going pear-shaped. So I would say that, if you had to pick one thing, that'd probably be higher in 24 months' time, and that most importantly, and this is probably a different way of thinking from the traditional thing, what's most important to you as a safe harbour, right? When everything goes pear-shaped and you lose your income and your house goes down in value and your equities collapse more generally, what's got a fighting chance within equities? Maybe gold equities, right? I'd say 24 months' time. Because of that contribution to the overall portfolio risk. It reduces your overall risk, right? So therefore, I think safe harbour, that's the way to think about it. Total portfolio approach, which is the way I think about all the portfolios. What's the contribution to your portfolio risk?
Yeah, look, not a lot to add there. I don't think there really is anything as a safe harbour other than a bank deposit, and you're not getting paid for safe harbours. But as I said earlier, certainly see an attraction in infrastructure and some areas of property. At least you have the real asset there underpinning the value of the investment. And also, I think there is an opportunity as the Australian dollar rises to get some benefit from owning overseas currencies, because that has been a fairly reliable source of diversification in periods of stress previously.
Brad, I might actually, I listened carefully when you spoke about infrastructure in your presentation and property, and coming from Victoria, we've got a challenging track record when it comes to public infrastructure, certainly. I'm just interested in when you look at that potential market and where you see can you make any comment on projects or particular areas that interest you, not so much in 2021, but perhaps for the next little short term? What interests you in that space?
Yeah, it's probably an area where the more boring it is, the better.
Yeah.
So from an investor's perspective, you're less concerned about the new projects because they're not necessarily investable at this point in time, and they don't necessarily change the outcome for existing infrastructure assets. So it's the things that are generating cash flow which proves to be reliable and therefore forms the basis of the valuation. And as I said earlier, I think the market's been a little bit that they've ignored that benefit over recent cycles and been attracted to other areas. But at the end of the day, when interest rates are zero and something's spinning off a yield of 3.5%, it becomes attractive. And if it's not highly cyclical in nature, and you can throw in a bit of CPI linkage at the same time, it becomes a fairly compelling investment proposition.
Yeah. Well, I was going to say, we would argue infrastructure has been hardly done by in the last 12 months in terms of just the performance. So we have infrastructure in most client portfolios, listed infrastructure. And the one recurring theme is, why do we have it? And look at the returns, have been terrible. And it's a fair observation, because infrastructure has generally been good in down markets. It generally has provided some downside protection. But because half of the sector's COVID, or half of the asset class is COVID exposed, obviously we think it'll rebound fairly aggressively off the back of reopening and vaccine distribution and the rest. So your toll roads, your rail, your airports should do better going forward. And that part's been almost priced like it's never coming back, which is just ridiculous. The utility part is the part that actually held up well, but there's concerns there obviously around long end bond rates rising and inflation. So how do they get priced going forward? But we would argue infrastructure looks pretty good for the next 12 months for those that can stomach that exposure. But the problem we're finding is the more we look and ask, people are selling infrastructure and property exposure just to fund more equity exposure. So this fear of missing out is how can I fund more equities? And so people aren't at the point of funding it from defensive assets, they're actually funding it from property and infrastructure. So we're finding property and infrastructure allocations in most portfolios are coming across, are getting drained left, right and centre for more equities. And we think that's a little concerning, to be honest. We just don't think, I think property probably takes 12 months to recover in terms of certain asset parts of the property market, but infrastructure for us looks pretty good shape, to be honest. So, and we just think the flood of private money that has to be invested at some point. So you've got these private vehicles that have cash that have to put their money into infrastructure, and there's no unlisted assets for sale around the world. So the only thing they can buy is listed assets. So the listed assets are going to cop bids left, right and centre. And these unlisted providers that are bidding for these assets, they're not price sensitive. Like the Aussie Supers and the rest, they've got 100-year investment time horizons. They don't care about price. They just want an asset. I mean, so we've actually asked listed infrastructure managers what happens in the next 3 years if all your listed infrastructure stocks get taken out. And they're like, well, we're happy. We've got them taken out at 3 or 4 times the price. But there may be actually less infrastructure stocks available in the next 3 years as they get taken out.
There'll be more growth infrastructure in Victoria, right, with security bracelets and jail cells and stuff.
I think you might be right, actually. Look, I think we're sort of, question down. Can we get a microphone down to that gentleman there? He's popped up from behind a concrete pillar. He's excited. We need a microphone to him.
Okay, thank you to the panel for such a thoughtful and excellent conversation. Now, I want to focus on alternatives, if I may, so more towards Jerome. But you could argue that GameStop was a failure of risk management on behalf of hedge funds, overly shorting to a ridiculous extent, a stock that maybe was a capital misallocation in the first place on behalf of the alternatives community. How are you thinking about risk management processes when you select a hedge fund? Are you changing your view on how that works? Is that their responsibility? You're able to mitigate that when you build a portfolio yourself? Maybe a bit of your insight, first of all from you, given you're an expert on alternatives, then from the rest of the panel, potentially, how they feel about that.
Look, excellent question. It's not without risk, right? When you go into the alternative space and you go into active management, you're taking different sorts of risks than if you just take beta risk or market risk. But as I mentioned, the important thing is you're diversifying your risks, right? You're taking different sorts of risks. And as long as you're getting a return for that risk that you're taking and you can actually assess it, then it's okay. And the beauty about it is that there's a very wide spectrum of different quality within the space. So if you can get into the top quartile type managers, you really can get great results out of a wide spectrum of opportunity. So you need to do that. You need to have a research process and the experience to be able to assess those things. So GameStop, isn't the first time there was a short squeeze, right? So those of us who assess, managers, long-short managers, have always had to be really concerned around shorting risk, right? What the different risks that come in when you're short. There's a great portfolio benefit because you're able to reduce market beta if you're using shorting. But there's a lot of nuance required in how you actually address the shorting risk. And it's very important, not to be in crowded positions, and it's very important not to be super concentrated in shorts, right? It's a really basic thing. But Melbourne Capital, I think they started off with about a 3% short in GameStop. After it had fallen quite low, and there was actually a bull case for it as well, which is quite amazing. So it seems like a monumental, I don't know Melbourne Capital personally, right? But it seems like a monumental, risk management failure. And it was something that you could look at quite superficially and say, look, it's just not appropriate in this relatively small illiquid stock to have a 3% short. Furthermore, the thing was actually shorted, by over 100%, right? Like you have to be insane, right? Basically, to want to take on a short position like that. Basically, my view, right? There's just no way, if you're a prudent manager, you'd even be entertaining such a thought of even shorting something like that, let alone shorting 3%. So these things are things you could actually pick up by actually doing manager due diligence and manager research and avoiding the people like that. Are you going to avoid every single disaster out there? No. But should you avoid most of them? Yeah, absolutely, right? You can avoid a lot of disasters if you know what you're doing.
Yeah, unfortunately, I'm going to agree with Jerome about the diversification in alternatives. I think it's been a mistake in retail portfolios. There's been, where they have had alternatives, there's been too narrow a exposure. Advisors are prepared to own 4 or 5 equity managers who might have a correlation of 0.8, 0.9, whereas in the alt space you can get negative correlations, and so the case for diversification is actually stronger. So I think you should have at least 4 or 5 different alternative strategies in a portfolio to really manage it properly. And I think that's been one of the issues to date.
Yeah, I'd agree with that. I think the one part we spend time with long-short managers or market-neutral managers in particular, and we zero in on their shorting and spend a lot of time on their shorting just because we find that's not a skill set that's widely held. People think they can short, but most can't. It's a very unique skill set. Effectively, you're an equity investor that thinks negatively about almost everything, and that's an unusual characteristic to find. So that combination is not common. So when you do find it, you then have to test that thesis out. And one of the things that we commonly have asked in the last 12, 18 months is there's obviously a lot of market momentum in terms of things going up. And we're checking with managers regularly that we do have in portfolios that do long short. Are you shorting for momentum, like against price rises? So if you're shorting a stock that's going up, it's got momentum behind it, we just find that's a fail automatically. That's a red flag. We would actually dump a manager on that basis. So you have to have other thesis as to why the stock's is too expensive. Is there a catalyst? Is there a fraud? Something misreporting? Overly aggressive accounting? There has to be other reasons. If you're literally shorting a stock that's going up, for us that's a red flag. You're out. There's no questions asked, and we make sure we tell our managers that before we invest in them to say that if we find or see that, we'll dump you straight away. Because the last 3-4 years have been very clear that momentum can go on for longer than you can stay liquid or solvent or in business. So why would you fight that? That's just dumb for us. There's so much other stuff you can short. Why short a stock that's got heavy momentum going for it? So there's some of the red flags, but there is a range of other red flags that you would use in looking at and assessing managers in that space.
Thanks, gentlemen. Any further questions? Last few. Just looking around the room. I think the energy's down. I think it's possibly a drink is calling. So look, gentlemen, thank you very much for your sessions during the day. Chris, thank you for hanging around, for being here all day. You were first cab off the rank, but it was a challenging topic, and I think you guys all dealt with it really well, and appreciate you being part of the panel and answering the questions from the floor. And really, to all of you, congratulations for coming along. It's great to see people finally live. Well done for coming out of your homes, getting away from behind your screens and connecting with some other humans. To Toby and Jenny and Amanda and Jane and the whole IMAP team, congratulations on putting together a really good full day of interesting and diverse topics in a challenging environment. I think you've done very well, and we look forward to the rest of the year. And please join me in thanking the team and join us for a drink across the road. Thank you.